everyone, welcome back to VetSick here. Today I've got something really interesting to share. How to check if a bond is overpriced or underpriced on non-coupon dates. Now I know bonds might sound complicated, but trust me, by the end of this video, you'll understand it easily and even be able to calculate bond prices like a pro. So let's dive in. Before we jump into calculations, let's quickly overpriced mean. Overpriced bond. If a bond's market price is higher than its fair value, it is considered overpriced. This means you're paying more than what it's worth based on expected returns. Not a great deal unless you have a specific reason. Underpriced bond. If a bond's market price is lower than its fair value, it is underpriced. This could be a good buying opportunity because you're getting the bond at a discount. Our goal is to compare the market price with the bond's actual worth, which when we calculate using present value or PV and yield to maturity or YTM formulas. Now, bonds don't always trade at their face value because of interest rates. If market rates go up, bond prices go down and vice versa. Second is time to maturity. As we get closer to maturity, the bond value. And third is market demand. If more investors want the bond, its price increases. So now let's calculate whether a bond is overpriced or underpriced when traded between coupon dates. To check this, we compare market price or P, the price at which the bond is currently trading, theoretical price or PV, the actual worth of the bond based on expected cash flows. If market price is greater than theoretical price, the bond is overpriced. If market price is less than theoretical price, the bond is underpriced. To calculate the theoretical price or PV of a bond, we use the formula PV is equal to sigma C over 1 plus R raised to the power T plus F divided by 1 plus R raised to the power N, where PV is the present value or theoretical value of a bond, C is the coupon payment, R is yield to maturity or the market rate of return, T is equal to time period, F is the face value of the bond, N total number of periods till maturity. And to get the discount factors for each cash flow, we use the present value interest factor or PVIF, which is equal to 1 over 1 plus R raised to the power T. This helps us adjust future cash flows to today's value. Let's take a real example. Now the bond details are face value is equal to rupees 1000, coupon rate 8% per year paid semi-annually, so rupees 40 every 6 months. Maturity is equal to 2 years remaining. Market interest rate or YTM is equal to 9% annually or 4.5% per 6 months. We are pricing the bond 3 months after the last coupon payment. So it's a non-coupon date. The step 1 is calculate present value of coupons. We discount each coupon using PVIF. So PV of coupons is equal to 40 divided by 1.05 raised to the power 1 plus 40 divided by 1.05 raised to the power 2 plus 40 divided by 1.05 raised to the power 3 plus 40.1.045 raised to the power 4. Sounds complicated, but don't worry. So all this is equal to 38.28 plus 36.63 plus 35.04 plus 33.55, which is equal to rupees 143.50. Step 2 is calculate present value of face value which is the rupees 1000 at maturity. So PV of face value is equal to 1000 divided by 1.045 raised to the power 4, which is equal to 839.26 rupees. Step 3. Add PV of coupons and face value. So that is 143.5 plus 839.26 is equal to rupees 982.76. Now let's say the bond is currently trading at rupees 990 in the market. Since rupees 990, which is the market price, is greater than rupees 982.76, the theoretical price, the bond is overpriced. If it were trading at rupees 970, it would be underpriced and might be a good buy. Now, I understand the formula was extremely complex, but the simple way to do this is use Excel's PV function. The formula is equal to PV rate, NPER, PMT, FE, type, where rate is the discount rate per period, YTM divided by the number of periods in a year. NPER is the number of periods, total remaining payment periods. PMT is coupon payment, negative because it is a cash inflow for the investor. FV is the face value of the bond, again negative because it's a cash inflow at maturity. Type is 0 for payments at the end of the period. Now let's say we have a bond or FV is rupees 1000, coupon rate 8% annually or rupees 40 paid every 6 months, remaining time to maturity 2 years or 4 semi-annual periods, market interest rate or YTM is 9% annually or 4.5% per 6 months. So the Excel formula to calculate the bond price is equal to PV 4.5%, 4, negative 40, negative 1000, 0. Now breaking down this formula, 4.5% is the market rate per period, 9% annually divided by 2 periods. 4, number of remaining periods, 2 years into 2 payments per year. Negative 40 is the coupon payment, negative because we receive it. Negative 1000, face value at maturity, negative again because we receive it, and 0, payment happens at the end of each period. So the Excel output here is rupees 982.76, which is the theoretical bond price. Comparing with market price, if the market price is rupees 990, then the theoretical price being rupees 982, overpriced. If the market price was rupees 970, it would be underpriced. So whenever you're evaluating a bond on a non-coupon date, just use these formulas to check if it's worth buying or selling. And that's it. Now you know how to check if a bond is overpriced or underpriced on non-coupon dates. Here's a question for you. Would you invest in bonds at a discount or stick with stocks? Comment below. If you enjoyed this video, hit the like button, subscribe, and turn on the bell notification so you don't miss out my next video. Also, if you want to support this channel, consider joining our membership program or using the thanks feature below. It really helps me bring more valuable content for you. Until next time, happy and safe investing.